Thanks for the introduction, Roland. And thank you everyone for coming along this evening. And if you're a shareholder in Caledonia already, then thanks very much for your trust and confidence in us. And if you're not, thank you very much for your interest in us. My name is Matthew Masters. I'm the CEO of Caledonia Investments. I've worked at Caledonia for 18 years. And it's quite interesting because I was chatting to a couple of you beforehand outside who've put some cash into their ISAs. There's one thing to put the money into the ISA. It's quite another thing to work out what to go and buy with it. And it kind of reminded me about how when I first started investing, I just thought it was a bit of a nightmare. Because you open up the FT and you just think, how on earth, how can I make this work for me? And that's basically at Caledonia, as you'll see, that's what we're solving for long-term investors. We're solving how to save in a methodical, sort of business-like way, so we minimize the risk of making a big mistake and maximize the chances of getting good equity returns as we go forwards. I call it, we'll go through the strategies, but I call it having a cake and eating it. So I think you should be really demanding when you move your money from cash into shares. I think you should be really demanding about what you go and buy with it. And I think you should have your cake and eat it. Roland's already done the cautionary statement stuff. So we're a long-term investor, and here are some highlights about the structure of Caledonia, which has been going a long time. So the Kaiser family, who are behind Caledonia, were a shipping family, and they're approaching 150 years of being in business. And Caledonia is approaching its 100th year. So we've been going a long time, and our dividend has been going up every year for around 50 years. So this thing is pretty well founded and well proven over time. Some things I'd like to bring out about why we're a good place for long-term investing and therefore a good place to have a long-term investment. We would not encourage people to trade in and out of something like Caledonia. It's a long-term investment. So I'll just highlight some features. So our scale, so we're 3 billion of net assets, but what we're focused on is net asset per share. So the total return on the net assets per share over time. We've never raised money against an investment mandate. Why do I put that last bit in? Because, of course, when it was a shipping business, it was raising money to buy ships. But over the last 50 years, we've never raised money. So we are just looking after our current customers' money. And we're targeting long-term compounding returns, trying to keep the money alive, growing the value ahead of inflation. So there's no benchmarking in Caledonia. So if the markets go down and we don't go down as much, that's bad news for us. It's not good news. All right? We're trying to make absolute returns to our shareholders. And this has been successful over years. And over long periods of time, Caledonia tends to annualize at about 10%. But of course, no promises about the future, but that is what it's tended to do. We are self-managed. So what does that mean? So what it means is our office in London has the investment team in it. They're only working for our shareholders. There are no other strategies that the people are looking after. So that means that all of that intellectual capital, there's about 25 people in the investment team across different areas, is only thinking about the money that we have at the moment and no other strategies. Those investment teams have a remuneration package, and you can see mine, it's in our annual report, fully explained, and you'll see that I get paid quite a lot in Caledonia shares. And their remuneration package would be similar. So that means we're very, very aligned with our shareholders. And we have a big family shareholder, owns 49% of the company. And so we have someone who's been in business a long time with us. There's good governance, good stewardship of the business. Last year, we updated our logo, something which chief executives are quite careful about doing, to include the words "time well invested." And that was a result of an exercise that we carried out in the company to let people know why we do things the way we do them. And what it is, it brings out why these long-term features are very helpful for being a long-term investor. If you're making long-term investments, it's very helpful if you have a stable balance sheet, which of course we do have because we're operating as a company and not as a fund. So we can make long-term commitments. Because we're self-managed and the investment team is in-house and only thinking about our current shareholders, then the opportunity set that they build up is only for our shareholders. So everything is orientated towards being long-term. We're very long-term, so we have a very slow-moving conveyor belt. We will make 5 to 10 investment decisions a year, fresh investment decisions a year. Very slow-moving. So what that means is that the people who are working in the company have plenty of time to think about what they're going to invest in, and they're very knowledgeable about what they invest in. It's very high conviction, and that's very successful for us. I'll come on to explain that a bit more later on. And the combination of being long-term and having the investment team in-house has worked well in giving us long-term returns. So our portfolio is spread across 3 different strategies. It's roughly a third, and a third. And what this does is it lets each strategy be quite concentrated, but the shareholders have got the diversification and the benefit of having the 3 of them together. So just running through them, we have the public companies strategy. We've got 2 portfolios there. We have a capital and an income portfolio. The capital portfolio is the main portfolio, and it's looking to generate capital growth over time. It doesn't have a dividend requirement on it. And it's about 20% of Caledonia's net assets in the capital portfolio. And we're looking to invest in well-managed companies with good returns on capital that we can easily tell will still be doing, having evolved, what they're doing in 10, 15 years' time. Because we view companies as economic vehicles that you get into and you stick with and you let them do the investing work for you. And we do not like the investment teams pulling the trigger too much on chopping and changing because you invariably get it wrong. We follow companies for a very long period of time, and even really good companies have quite volatile share prices. So an example would be Moody's, which is a debt rating company. It's a really big US business, super track record. A couple of years ago, they had a bit of a sell-off because interest rates went up, so debt issuance went down. We'd been watching that company for 5 years. We'd met the CEO. We'd done all our homework, and you get the opportunity to buy a really good company at a reasonable price, and that's what we do. So we have a short wit list of very high-quality companies, and they all have share price volatility, which gives you opportunities to get into them. People say the market's efficient. It's just not. We invested in Microsoft in 2014. People has written the company off, and we've made 10 times our money out of it over that period of time. So you just be patient, and you get given really good investment opportunities from time to time. We have an income portfolio in there, and that is targeting a 3.5% yield on cost. We're not marketing that portfolio separate anywhere, so we're not interested in the percentage yield. We just want to invest in really good quality companies that can grow their dividend. So that's our public companies bit. We have private capital, which is our opportunity to invest behind, partner with good quality management teams in good quality UK businesses. We're looking to own about 7 of those within the portfolio, and we put about 50 to 150 million pounds of our own money into them. We sit on the boards of these companies, and we don't use lots of debt when we buy them, unlike conventional private equity. And over the last 10 years, that strategy has delivered 14% per year. I forgot to mention that the quoted bit is delivered 8.5% per year. And then in funds, these are private equity funds where a fund manager raises commitments from limited partners. You commit for 10 years. They tend to draw the money down over 3 years. And then everyone's very well aligned. So the management team running the company that gets purchased will be paid on a successful exit. The fund manager that we've backed will get paid on a successful investment and exit, and we obviously do well out of that. And it is nowhere more consistent and more powerful than in smaller companies in North America, which is basically the capital of capitalism, and they're all geared up for self-improvement, especially with business, and it's a very fertile area for doing this. And it's quite difficult, actually, to get access to in the UK. We're typically the only European investor in these American funds. And we also have some Asian growth in that area. The North American bit is just under 20% of our NAV, and the Asian bit is just below 10%. So those are our three areas, and they've all returned very well over the last sort of 10 years. Just to give you some case studies, this is one from our public companies bit, a company called Watco. When you're making a long-term investment, you really have to understand why a company's going to be good for a long period of time. Watco sells air conditioning equipment to residential homes in the US Sunbelt. I think people will need air conditioning in the Sunbelt of America for a long time. And Watco is a distributor in that market and is way bigger than its nearest competitor. And the way the market's set up is you have a few number of OEMs who make the kit, and there's no way they can be selling to the sort of man in the van who's rushing around fixing people's air conditioning kit. We invested, having followed the company for a while, we invested in February 2017. It was a period when they were investing in technology in their company, so the profits were a little bit suppressed. So we invested at a sort of low point, and then the company's made great progress, and we've made a 22% annualized return out of it, and we're still just as excited about its future as we were when we went into it. So it's a really straightforward business, and it's been a great long-term holding. Within private capital, we've just bought last year AirServe. So when you go and top up your tyres at the garage forecourt, when you put £1 into the air machine, that's one of our machines that you're probably putting the £1 into. We split that £1 with the forecourt owner, and we own the machine. We're responsible for maintaining the machine, and the forecourt owner is very incentivized to let us know if there's a problem with the machine, because they want the uptime to be good. And the customer is therefore well served, because the machines tend to be well serviced because everyone's incentivized in keeping them working. When you get air for free, no one's really that incentivized to keep the kit working. So we're by far and away the largest operator in the UK market, and we also have decent sized operations in Europe. We bought that business last year for just under £200 million, and we invested 143 million into that. And it is performing very well so far, so we're very pleased with it. The best investing we will do at Caledonia is investing in new machines onto new forecourts, because the return on investment is pretty well known, and putting an investor partnering with a good businessman is a very, very powerful way of making consistently good returns. So really, really enthusiastic about that growth. And then in funds, this is an American lower mid-market fund called Centro. You can see we're invested in a couple of their funds. You can see the fund sizes and how they've been getting on. Money on multiple is telling you what the valuation of the fund has done since we've invested it, so they've both sort of doubled our money. Centro 1 is a 2015 vintage, so we've had a lot of our money back. Centro 2 is a 2021 vintage. That's the year when they launched the fund, so that's still quite early in its progress. And these guys, this is run by a guy called Randall Fautigé, who used to run a business. He's a businessman, and he runs this private equity company, and they buy small industrial companies and then help them grow. And in America, if you buy a small company, and if you add extra capability to it, extra people, you broaden its geographic spread, you've got a massive market to scale up in, and America is geared up for that. So an example would be Collision Right. When they first invested into that, they had 30 auto repair centres in 3 states. And then when they then sold it, it had sort of 90 repair centres across 9 states. And you've just got that growth opportunity each time with these small companies. And they tend not to push the debt levels. It's sort of very much more of an equity-driven strategy, so you don't have quite the same debt risk as you would do in bigger buyouts. And this area has just been such a consistent performer of just letting American capitalism do its work for you. So the performance of the trust has been is shown here, and people can separately judge what they think about it. The gold bar is our NAV total return, which is what we're focused on, and you can see over 3, 5, and 10 years, we've been doing 10 to sort of 13% in annual returns from the NAV total return perspective. It doesn't quite show up so well on the screen, but the far right bar is the UK stock market. That's just to help you calibrate things. We're not benchmarked against it. And then the centre bar is the share price total return, which is similar to the NAV, but unfortunately it's lower over 5 years, and that's because Caledonia's discount has opened up. And Caledonia, until 2021, Caledonia traded on a sort of 19-20% discount, and that has now increased to sort of the mid-30s. Most investment trusts, well, all investment trusts have had their discounts open up, and especially those with unlisted assets. And we've got 2/3 of our portfolio in unlisted assets, so we're not immune from that. So the discount has opened up, and that has got in the way of the NAV performance and the share price performance. Discount is now consistently in the mid-30s. So if you got on the share about a year ago, the total shareholder return is almost the same as the NAV return. So I'm hoping that will remain the case now. So just to finish up on why Caledonia. So Caledonia is set up for making long-term investments. We've got the benefit of this family backing and our balance sheet, meaning that we really can be long-term. And then all of the investing being done by the investment team in-house and only thinking about our current shareholders' money. So not raising any extra money and not looking after any other strategies. So all of that intellectual horsepower is going into thinking about our current customers' money. Before I finish up for questions, I'll just put our Manifesto up, which is an awful term because it's very laden with political sort of side of things, but it's a perfect descriptor of this prose, which is written by people from the company, expanding on this time well invested and how we think about working with each other, the people we invest with and the people whose money we look after. And I'll just leave that as a backdrop as we take questions.
Lovely, Matt. Thank you very much indeed. Thank you. Question right down the front here. Chris, would you mind waiting for the microphone, please?
Sure.
Thank you.
If you weren't the Kaiser Family Investment Office, would the discount be significantly reduced?
I don't know. Possibly. I think that what it does is it somewhat reduces the liquidity of the shares because half the shares sort of never trade. And so that means if you're a very big wealth manager, then you don't perhaps have the liquidity that you might want.
A question here, please, Chris. Thank you.
Yes, hello. I'm John Rogers. I'm a private investor and I hold your shares. I'm concerned about the discount. I mean, but what is the reason for such a large discount? I mean, are you worrying about the corporate action because of it?
So with a 49% family shareholder, we're very unlikely to have an activist turning up.
So what are the reasons for such the large discount?
Well, it's to do with the unlisted holdings. You look at other investment trusts with unlisted assets, their discounts have all moved out. Some have moved out further than Caledonia's has moved out, relatively speaking. So it's a feature of the sector. When you sort of look on the charts to see when these discounts moved out, it was around about the time that interest rates started going up. We were in a world of sort of 0% interest rates, so lots of people would have allocated away from cash and would have invested into more sort of equities and things. And I think when you can get 5% in the bank, it's perfectly rational to want to move some of that back because there's sort of very little risk with that. So I think we're sort of seeing that going on. So and there's cost disclosure issues and general sentiment about UK equities as well doesn't help. So there's a number of different things that weigh on it. We're certainly not worried about the value of our portfolio. We've been buying back our shares almost every week since March. Buying back shares probably won't influence the discount, but will certainly enhance NAV per share. Because if I can buy in the secondary market, so these are voluntary sellers of our shares, if I can buy in the secondary market at a nearly 40% discount, then everyone else who stays behind benefits.
Yes, just concerned about large family selling. I mean, has the family percentage gone down in the last 2 years?
They don't sell. There was an episodic sale in 2002 when Sir James Kayser sort of broke away from the family. But since then, they tend to buy a little bit. They don't sell.
Yeah, thank you.
Just a quickie. So you're talking about the discount and private market, the private company valuations.
Yeah.
Can you describe how the private companies in your portfolio are valued?
Sure. So it will be consistent across both the ones that we own and the ones that are in the funds. There are international guidelines, accounting guidelines about how to value private assets, which is a formula that we all follow. And then they all get audited, properly audited once a year through the audit process, and then they get reviewed by the auditors at the semi-annual points. We try to be conservative on our valuations. No one likes to sort of overpromise and underdeliver. And we have a track record of things tend to get sold. When they eventually get sold, they tend to get sold at a bit of a premium to what we've been holding them at. And we sold 7IM last summer in a weak equity market, and it went at about a 30% premium to what we've been holding at a year ago. So, as I say, we don't have any concerns about the value of our portfolio. And we wouldn't be buying in shares for cancellation if we didn't think that.
Question over here, and then we'll come to you. Oh, back here. Okay, and then we'll come to you.
Thank you for your presentation. Many investment trusts pay their dividend quarterly. Would Caledonia benefit from doing the same?
I have a lot of sympathy for that. There's something we're going to think about because it can be quite difficult to work out dividends when the interim's different from the final. So we are thinking about things like that. But currently we pay about a third of the dividend at the interim, and then we pay 2/3 of it at the final. And then we do have a track record of occasionally paying a big special dividend. So we've paid about 3 of them over the last 15 years. And typically, if we sell a big private capital asset, and so we get a lot of money on the balance sheet, we might think about paying a special dividend. Giving people their own money back is something that we're quite happy to do.
Question here, please. Yeah.
Hello. I was listening carefully right from the beginning, and I was wondering what sort of company this is. You didn't actually say the word trust until almost near the end.
Yeah.
Now, obviously, it has got a very specific strategy. What I'm interested in is to tell me what other trusts does it resemble? Maybe from more well-known trusts. I don't know.
Yeah.
Because investment trusts by nature for investing are not always very clear-cut in terms of, why I should invest in this trust specifically, you know. So that's my question.
Yeah. So they're not the same, but the one that would have similar features is the Rothschilds.
Sorry?
Rothschilds Investment Trust. So we're not the same as them, but they do have a 30%-ish family shareholding in it, which was Sir Jacob Rothschild's family, and they have a mixture of assets in it.
It would help actually for each company that is an investment trust to call it Caledonia Investment Trust, because, you know, Caledonia Investments, I don't know. Thank you.
Question at the front here, please. Thank you.
Thank you. Thank you for your presentation. I first bought Caledonian in 2010, and I did it bits and pieces since, and I'm never entirely upset by getting out at a profit, which I did in 2021, because at that time I saw greater opportunities elsewhere, and I see that what I bought in the 3-year period has increased by 23% in one case, 38% in another, where over 3 years your share price has been flat. I think very carefully before selling something and buying something else. And by and large, I'm a long-term shareholder, and having a dividend record such as you have is attractive. But can you give me any reason why I should sell something, or two things in this case, that have been performing fairly well? Is there some indication of change of strategy, for example, that would give a higher return than we've seen over the last 3 years, or indeed 5? Which at 24.32% it is barely outperforming inflation in reality.
So our net assets have been doing 10% per year.
I'm sorry, my hearing is poor and I missed that.
Our net assets per share have been annualising at about 10-13% per annum. So the engine of Caledonia is fine. The issue we've got is the discount moving out has gotten between the net asset value journey and the shareholder journey.
That is certainly the case, and I understand that. And it would be fair to say that both of the companies that I referenced without name have a similar discount profile and a similar widening of the discount over that period of time, which has been a characteristic, as you rightly pointed out, I think, of a number of investment trusts, including particularly those with an exposure to private equity, which both of the other two do have. It's just, what reason could you give me for selling something at the moment in order to buy Caledonian, given those relative figures?
I'm not going to encourage you to sell stuff you're happy with. Hang on to it.
Thank you for that advice. Thank you for your input too.
Other questions from Matt, please. Question back here, please. Thanks.
So you've got a portfolio that consists of 3 elements: the funds, the public, and the private. I see from your slides that the funds were getting 17.3% per annum return. Are you fixed in your charter that prevents you from increasing your funds portfolio element, because you seem to be getting double compared to your public element? And secondly, without a benchmark, are you saying that we have to wait 5 years to see relative growth compared to inflation? Is that usual practice not to have a benchmark per se?
So benchmarks exist because there's a lack of trust in the system, right? If I'm stood here taking your money to invest, you've got no reason to trust me to do it well. And so you rely on a benchmark commonly so that you can compare my progress against that. That's why there are benchmarks. So with the big family shareholder there, and the fact we've never raised money, we've never resorted to having a benchmark. And when you get benchmarked, and also if you're asset gathering, you quickly find that you're trying to not be different from the benchmark, because then, of course, you might lose assets. So for me, a benchmark is a disease from our perspective. We don't want it in the system. We're only going to be pleased if we make our shareholders money over the medium to longer term. Very difficult to guarantee making money over short periods of time. I'm just not going to encourage you to do something rash in the short period of time because share prices are quite volatile. But over medium and longer term, with the approach that we've got here, we're reasonably confident that the capital will at least keep alive, as we call it, and keep making progress ahead of inflation. Now, the temptation is to sell all of that lot and buy all of that lot. Okay? But of course, hindsight's a wonderful thing.
I guess also you need the public companies for the income components.
So by now, because we've been going 100 years, pretty much the whole balance sheet's distributable. So we don't actually need any income to keep making our dividend promise. So, but we do like it. We do like having some income coming in, so we're not having to think about what to sell in order to sort of pay out the dividend. So it's more of a sort of, perhaps how a businessman would organise his or her affairs, so you have cash flow coming in to cover your costs and dividend.
Matt, the screen's telling me it's time's up. Thank you very much indeed. Thank you for coming tonight.
Thank you.